Here we go. We are live and being recorded right now. I want to thank everybody for joining us for today's Million Dollar Thinking. This is actually our first webisode of 2021. So welcome everybody belatedly to 2021. We know that a lot has gone on since the year started, and we are fully expecting a lot more to happen as the year progresses, particularly in our corner of the world, in the real estate world, behind myself and behind Ty as well. We've got the real estate world in our mind, and Brian Phillips is sitting comfortably at home. So these are my co-hosts. I am Derek Hall, president of Charter Real Estate School. I have with me Brian Phillips, broker at large at Element, as well as Taiwan Anthony, who is I want to say property manager extraordinaire. I think that,
I
that
like
fits.
that.
Yeah. So everyone I talk to says, "Oh, Taiwan knows everybody," so we're going to call you property manager extraordinaire for now. And so joining us also, we have Shimon Shkury and Victor Sozio of Ariel Property Advisors, who have put out, everyone knows, I think, on this call here and around the world, that Ariel is great for property data. Myself coming from a property data company as well, I know good information when I see it. So I'm really happy to be joined by these gentlemen. They're going to discuss some of the information they've been putting out in their reports recently, particularly projections for this coming year. Obviously, the COVID pandemic has had quite a large effect on New York City. We're hoping to start feeling the effects of the after effects coming out of it. We've got more vaccinations coming. Movie theaters are going to be opening up March 5th. So we're excited about some of the things that are going to happen. And there's been some good news, according to the guys at Ariel. So I'd like to hear their thoughts on what to expect this coming year for the real estate market.
Thank you. Thank you, Brian. Thank you, Derek. Thank you, Taiwan, for having Vic and I here. Why don't we start by just introducing ourselves. I'm Shimon Shkury, president of Ariel Property Advisors. With me today, Victor Sozio, my partner at Ariel Property Advisors. And what we're going to do is speak briefly about what Ariel is, and then jump right into some information that we've seen in 2020 and how it leads us into 2021. And Vic and I will play where we talk about numbers and we talk about deals and what we see in the market. We're interacting with buyers, sellers, people who want to finance or raise equity on a daily basis. That's part of Ariel. We have 3 divisions. The first one is investment sales. Each one of our brokers focuses on a specific sub-market in New York City. So we get to know the city intimately throughout every borough. The second division we have is capital services, where we produce or place debt and equity for our clients. And the third division is what you mentioned, which is the accumulation of information in the form of investment research and a lot of property reports, as well as market reports that we produce. And so if you look at 2020 and you look at about a year ago, you haven't seen great news. And 2020 has been a tough year. It's not a secret. We've seen volume of transaction go down to about 17 or 18 billion dollars. That's about less than half of what it was in 2019. If you want to compare it to 2009, which was the prior downturn, we're still above that. We're about double what it was in 2009. In 2009, it was about $6 billion. So we're talking about a substantial drop, but still not as bad as it used to be or was during the financial crisis. Multifamily pricing has come down throughout the city. And that's not a pandemic related. That's really not just a pandemic related. That's also HSTPA related, Housing Stability and Tenant Protection Act, which affected the rent stabilization market. And Vic, before I move into talking a little bit more about development and about the reaction to COVID-19 and what we've seen, do you want to comment on the multifamily market and the valuation changes that we've seen over the past, maybe 12 or 18 months and what we're seeing in this market?
Sure. I guess maybe it's appropriate to touch first on HSTPA
Sure.
and where you started. I see the congressman just joined us, Derek. So do you want to, shift gears first and come back to this? Is that better?
Yeah, let's take a look. We've got we're waiting for audio. So there we go. So let's see. I appreciate that. Good eye there.
No problem.
Thank you for joining us, Congressman Espaillat. Are you able to hear us?
I think we might have, okay, there it is.
I think we're still getting
Can
situated.
you hear me now?
We can hear
Yes,
you now.
there you go.
Well, thank you. Sorry I was in session, but thank you so much for inviting me to this conversation. And I want to thank everyone associated with this conversation. And in reality, I think that, you probably have better answers. You're in your field, deeply rooted in your field, and you probably have better answers than most New Yorkers. And so I want to say that housing continues to be an important issue for the city of New York, for my district, which is a very iconic district that has very defined neighborhoods like Harlem, East Harlem, Washington Heights, and Northwest Bronx, Hamilton Heights, Inwood. These are all neighborhoods that are very much designed by and descriptive of the families that live there. So when you go to Harlem, which is really the capital of the African diaspora in the
I like
world,
that. I like that.
people come from all over the world to see, and there are Harlems everywhere. Every city, probably every major city in New York has a Harlem, and every country that you go to, you can go to a neighborhood and say, that neighborhood reminds me of Harlem. The same for Washington Heights. It's an immigrant community. You go to any part of the world, you will go to a neighborhood where newly arrived immigrants come in and try to make it and move forward in that society. So housing plays a critical role in all of this, right? Because it's usually, and for the most part, the biggest staple of your family budget goes to housing.
Yeah.
And so we must promote ownership. I think that ownership is an important component that we must do better in. And we must continue to fight for affordable housing. I believe that affordable housing is critical. Right now, I'm in the process, since I am a member of the Appropriations THUD subcommittee, which will deal with transportation and HUD related issues, to meet with advocates and folks in the arena like yourselves, to hear from you and get from you what are your recommendations as to what HUD should be doing better, or what are new ideas that we can reinvent HUD to be practical to the post-COVID-19 realities, right? Which are real, and they will play an important role in society for some time to come. So I am fact-finding and getting ideas of what's the best programs within HUD, which are the ones that need to be adjusted. So do we increase the Section 8 vouchers? To what level? The tax credit system within HUD that makes it affordable for the creation of affordable housing. What do we do with it? How do we reinvent it so that it is a practical tool that developers could use on the ground? So I hope to engage with you as we move forward on a constant basis, so that you can be a source of ideas and innovation for me and my office, so the neighborhoods that I represent continue to be iconic and accessible to people from all over the world. So I thank you for inviting me. I hope that your conversation is a productive one, and I hope that you invite me again in the future. Thank you so much.
No problem. Thank you. We'll definitely take you up on that.
Thank you.
Thank you. Take care.
Yep.
Have a good
Thank
one.
you.
You
All
too.
right. Thank you. Thank you.
Before we move forward, Vic, I wanted to
I guess no Q&A.
Yeah. I was waiting. For the Q&A. I had a
Right.
couple of questions there. What I was going to say. I know Harlem is a good place, but what's going? But where's the
Right,
science, man?
exactly. You gotta keep it good.
Well, I think the congressman, at least it sounds like he's really in in a learning mode and
Yeah,
wants to
yeah.
improve and improve in a way that takes developers that are private and give them the right incentives to put affordable housing
Yeah.
in place. And I think
That was a
that's
huge
important.
takeaway. Yeah.
Right. It's a three-way street. First of all, you have to take care of the tenant. You have to make sure they have the right amount of money that they need to pay, not too much, and the right accommodations, the right buildings, the right amenities. And then you have to make sure that the developers have the right incentives to
Exactly.
really build, maintain, and preserve affordable. And you have to make sure that the government backs up, the developer
Absolutely.
and makes sure that the same developer eventually develops what was intended to and protects the tenant in that way. So this is the way I look at it. It looks like he has the same kind of process of thinking.
And we'll be here to remind him if he loses sight of that.
Yeah,
Right.
and you know what, Shimon, I think it's interesting, right? And what I'll say is this: it's always a double-edged sword when you're talking about affordable housing, right? In places like Bed-Stuy and Harlem, I've been on my community board for about almost 10 years, and what affordable looks like. What does that mean, right? So we're talking about
Right.
AMIs. So when we break down into what is the AMI? Is it 30, 40, 50, whatever it is of AMI? So that is important
Let's
too.
first break down what AMI is for those of us who may be
Area, so
uninitiated.
yeah, so AMI is the area median income,
Income,
and I'll
yeah.
let the experts over at Ariel get into that a little bit more. But from what I see, you have development, and I know the HUD process, the tax credit process, the RAD, all of that stuff has been hit pretty hard. So developers are not making, especially when we're talking about the nonprofit affordable housing developers, and I've worked for a couple also too. It gets really tough. Margins get really tight. And then even on the other side of that, 2019 ushered in a whole new wave of laws, right? So it made it hard to deal with tenants. So I always look at it as somebody who is a landlord, a property owner myself. I've been a tenant, and I live, in places like, in places like Bed-Stuy. I kind of see both spectrums of it, and it's going to take some real no nonsense. It's going to take some real people that care about the community in these positions of leadership, so we can move forward. This year is very, very interesting. And Derek and I we can talk about it even more. We have, we're going to have soon, we're going to have a new mayor, we're going to have a new Brooklyn Borough President, we're going to have new council members in places like Bed-Stuy, I think half
New
of the city
Comptroller.
council. Yeah, exactly, a new Comptroller. So, we have a new president, that just took office. We're in very interesting times, and I think the people that we elect is going to create or affect policy for the next 4 years. So it's very important for communities that are affected by affordable housing issues to go to your community boards, to go to your council members, to go to your senators, and really try to make some sensible laws that help out both the landlord and both the tenant as well.
Right.
I think I want Vic to comment on that, but I think that the overarching affordable housing sometimes gets confused with, for example, just units that are rent stabilized units. So not necessarily
People think affordable means lower income, and it doesn't.
Right. So it could be lower, it could be middle, but it's a little bit different. So we started touching on that, Vic, on what happened with HSTPA, and we started touching a little bit about what happened with values of buildings. I don't know if you want to touch on that a little bit.
Yeah, I'll touch it briefly, and I'll say it's all interesting commentary, and I think you're all right. I think it's what's clear, and what the last few years have taught us is that to have a real productive dialogue, you need all the stakeholders at the table and discussing what's good and what's bad, what's productive, right? Versus what is just, a splash and what looks good on paper, but what ultimately in 5 to 10 years won't pan out the way that it's anticipated to. Right. And it's almost like the congressman came on cue when we started talking about HSTPA. But, I think it's appropriate to start there when you think about what's happened with multifamily values. Right. And if you think about what happened up to HSTPA from 2010, really up until 2018, volume went through the roof. Right. And it was really driven in large part by speculation, right? Speculation about where the rents can be, where the rents can be after I turn over this unit. and bring up the rent, destabilize the unit.
Mhm.
And that was a problem, right? People went too far. What happened is you had some bad actors.
A lot.
Bad actors kind of muddied the waters for everybody, where ultimately, once there was, a change in the majority in the Senate, and it was kind of ripe for this legislation, right? And the legislation addressed a lot of these issues, right? The main one being displacement, which is a legitimate issue that was, that people were being affected by during this period of speculation. But what it also did is it fundamentally altered the dynamics and the mechanics of multifamily ownership in a way where really the incentives and the mechanisms that were in place that allowed for further investment into properties to maintain and upgrade an aging housing stock, they were stripped, right? So that's where HSTPA, again, well-intentioned, but in some places went too far, where now we have a very old housing stock that is starting to deteriorate. And if you think about it, HSTPA almost reversed it, where now owners are trying to be as lean as they can on expenses, and the actual properties and the tenants are affected by that, right? So there was good things and bad things that came out of it. What it did do from an underwriting perspective, and what's clear, is in the past where properties, multifamily properties specifically, were purchased at very low cap rates, right? Rate of returns for what was in place, with the hopes of underwriting and eventually getting to a higher cap rate, that kind of went out the window, right? Because these mechanisms that we touched on to increase the legal rents or even destabilize these units were essentially watered down to the point where they're non-existent, right? So multifamily properties that might have traded for a 4 cap, right, before HSTPA, now really have to be looked at in a different lens where, hey, where's the income, right? Let me get very disciplined on my underwriting and where my expenses are and what my capital expenditures are going to be for the next 5 to 10 years. And where can I finance that where I can cash flow well based on what's in place versus the dream of what it could be if I turn over all these units and destabilize them and bring it to market. So cap rates really shot up, right? Where we saw average cap rates around the city, and depending on what market, if it was between 4 to 5, all of a sudden after HSTPA, that went up 100 bips, right? And it's
For rent stabilized units.
Even
Rent stabilized.
In some areas, right? On units, on buildings that were predominantly rent stabilized, right? Then when you follow that with a pandemic, right, it kind of reversed things again, where all of a sudden the properties that were being most affected were the ones that had market units, where people were leaving the properties, going back to the suburbs or wherever. A lot of young professionals and others left the city. And now, when you look at transaction volume in 2020 and values, they were greatly affected by it, right? There was a ton of vacancy. Vacancy is really at a level that we've never seen, right? In my career, I've never seen.
It was pretty scary.
At 15, 20%, you ask some of the biggest Manhattan property owners, and they'll tell you in the middle of the pandemic, their vacancy was easily 10 to 15% or more. And that's kind of an absurd level. So I think when you look at the dollar volume and what's happened there, that's a big reason. People just didn't know what to underwrite, and there was no confidence in the assumptions being made.
So from a numbers perspective, Vic, and this builds on what you just said, just to take unemployment. Unemployment went from 3.4% in March, in the middle of March, all the way up to 20% in New York City up to June. Now that's a real reaction, and that's really what led a lot of these vacancies that Vic was mentioning, especially the vacancy that's especially took place in good areas in Manhattan below 96th Street, where students and young professionals live. So it was definitely a reaction that over a 3-month period, unemployment went up so much. But the good news, and this is the beauty of this, is that at the same token, over the 6 months after that, between June and December, the unemployment rate had gone down to 11%, and it keeps going down slowly but surely. The other good news is that the last quarter of 2020 showed from a state perspective, from New York State perspective, that there was a significant increase in new businesses that opened up. So our projection is that unemployment will keep going down steadily. And that's a real, that's a real good thing. So saying that the worst is kind of behind.
So I want to pose a quick question, and thank you for that, Shimon. So here's what, and I'm going to talk a little bit about the commercial side. That's where my love is. So like I mentioned before, right? So I've been on my community board for about 10 years, and I chair the Economic Development Committee. And what we do, we're responsible for approving SLA, so businesses that are looking to serve alcohol. So we approve that. And a metric that nobody really talks about is that. So in Bed-Stuy, we normally see 5-6 applicants a month. Last month, we seen 0, right? And so now the prospect of coming to a place like a Williamsburg, like a Bed-Stuy, like a Lower East Side, it doesn't seem that appealing to a small business owner who's looking to open up food establishment, food and drink establishment. So, and it's interesting. So, along Fulton Street in Bed-Stuy, there are some businesses who have literally went out of business during the pandemic. Right. They tried to set up the little outside cubicles that everyone sees now, that either takes up parking. That's the biggest complaint. It takes up parking, right? Some of them tried to do that. But just with the lack of foot traffic and people leaving the city in droves, a lot of these businesses were not able to sustain. So my question to you is, what does it look like for our commercial corridors, such as Fulton Streets and Bed-Stuy? So not only your main corridors like Fifth Avenue in the city, but some of those small and secondary commercial corridors that have a small pub, right? And I know Queens, Astoria has plenty of them where Derek is. What happens to those businesses? They are policies are changing seemingly every week, 25%. Then it goes back down to 0%. You can stay open till 11. Now you can stay open till 7. What are those businesses? What is the outlook for those businesses that are on those commercial corridors and are so subject to the changing policies and changing laws?
Yeah, I'm going to say a few things, and then I'll let Vic also add to that. I think the retail market got into this pandemic not in a great footing.
Yeah, exactly.
Okay?
I agree.
That's just what I was going to say.
Yeah.
I was just going to say really quickly, because just to piggyback on what Ty was saying, and I think what you're going to say is going to back it up. But like, for example, in Astoria, we have Steinway Street, which is one of those commercial corridors, which is primarily retail. Steinway looks terrible. But if you go to some of the avenues, which are commercial, like 30th Avenue, Broadway, which are predominantly restaurants, you're not seeing the same issue at all. So there's definitely, at least from what I'm seeing in Astoria, a difference between your hardcore retail and even your restaurant industry. Sorry,
that's a great point, and Vic can talk more to it, because I think we're seeing the same thing here in the boroughs. But the retail market got into this weak as it is, and I think that the pandemic definitely hurt it, right? I mean, if you're a restaurant, or if you're dependent on pedestrians, you can't stay open. There's no two ways about it. The opportunity, though, right after the pandemic is subsiding and getting out, is the fact that rents are going to be lower. And for the first time in decades, landlords will have to work with tenants in a little bit of a different way. It's either a lower rent or a temporary rent or some kind of partnership. So if you're a business owner and you have a vision, and I know Vic has been working with at least one of these tenants, and I don't know if you want to talk about it, but if you really have an opportunity to lock in relatively short, midterm, or long-term rents at prices you've never seen before, because landlords will need to do something. So I see this to an extent as an opportunity for new businesses, new retail businesses to flourish, because it's the first time in New York City's history that the rent could be not as high compared to the rest of their operating expenses. And so that might solve some of the problem. There's a bigger problem here with retail, but that's where I see a little bit of opportunity.
Yeah, I think we might see, like what you said, similar to when New York lost a lot of the big box retailers. You saw a lot of spaces broken down and a lot more boutiques opening up around the city. So I think you're right. You see more creativity, more different use of spaces around the city.
You have to.
Look, if you think about retail, it's been evolving, like you said, Shimon, for years, right? And it started where, frankly, a lot of transactions were being done based on underwriting that was not realistic to begin with on a vacant retail store, right? You know, you have to have a sustainable business that can actually sustain, not only pay you $150 a foot for the first 6 months, they actually have to make money and be able to stay there for a few years to avoid a lengthy eviction process, you know, and avoid a lot of downtime, not only while you're evicting, but leasing it up again. So I think that was the first problem. Then, you know, the bright spot was, you know, it was touched on the restaurants. Those were kind of, you know, a lot of the tenants that were still active as retail was evolving. And now this pandemic really affected that. I just don't know how, you know, a lot of restaurants could have survived, you know, a period like this without any income whatsoever. It's just extremely brutal what's happened in the restaurant industry. It's just really sad and brutal. The upshot, like you said, Shimon, and even in taking a step back in the broader context, we're now at a time for more sustainable, responsible ownership, right? Whether it's residential or retail, it's time to get real, right? It's time to get real on what can be done, you know, to look at your operating expenses and really get a good handle on it, to understand that, you know, it cuts all ways. You need to have a property that operates and is functioning and is profitable because it is a business. You need to have a tenant that's able to stay in place, right, without the threat of being displaced. And you have to have a retail tenant that's able to survive and thrive. Give me a retail tenant at $60, $65 a foot that I know has a good chance of being there for 5 to 10 years versus a pie in the sky $90 a foot, you know, just because I'm attracted to the sticker price number.
I agree.
So Victor, quick question. So what is that tenant? So what does that new commercial tenant look like, right? So I can't remember who it was. A friend of mine, they work for one of the larger tech firms, and they sent me the email. The tech firm said employees can work at home forever, right? So now traditionally, right? Let's say somebody has a marketing firm or a media firm, and they have, you know, 1,500 square feet. They don't need to be there anymore. So moving forward out of this pandemic, what does that ideal retail tenant look like, right? Now, the fact that so many people are going to be working from home for the foreseeable future. I mean, even for me, I'm still working home to a certain extent. I'm a property manager, so I have to be out of my properties also. But, you know, what does that tenant look like even after this pandemic? Because a lot of these tenants, retail guys, they may have scratched their head and said, okay, I can save some overhead if I just have everybody working from home. So why do I need a space? So what does that tenant moving forward look like? What does that ideal retail tenant look like?
You know, it's a really good question. I mean, and I think we're all trying to still figure it out where
It's $1 million question.
Some pockets of activity is it still is, again, you know, where we're seeing more depth to the retail market tends to be in the workforce housing locations that have the lower rents, and they tend to be mom and pop shops, right? You know, they might not have the strength of a Target per se, right? You know, or the what is the clinics names? Everybody wants a
medical. The medical MDs.
Yeah, you know, everybody wants that tenant right now, right? It's a clean use, it's sustainable, right? Like everybody wants that tenant, but they're not there. But what we're seeing, you know, I've seen a mom and pop pet shop, for instance, recently get an application out, you know, on a good retail unit, right? I've seen still a restaurant, right, that actually, you know, is a trendy, like vegan casual fast food place, you know, but more based on delivery versus actually, you know, being in place. And that's, look, we're going to have to figure it out. If you think about before the pandemic, there was a little bit of shift to what was called experiential retail, right? And even, you know, Foot Locker had something coming up in Washington Heights, I believe, right? That was their first experiential shop where you go in, you play Xbox, you look at the highest selling product. And that was cool. And I actually like the idea, right? But now things have affected that. And is it something that's going to actually be sustainable going forward?
The other thing that's happening on the retail front, and I agree with Vic 100% that it's the smallest spaces at the mom and pops. Some of these retail stores, you know, some of the tenants left. So if you had a bar or a restaurant that left, it's easier to put a tenant in because everything's already there. So
Right.
on specific neighborhood, let's say even in Manhattan, on the Upper West Side, when you have a small bar and your dream was to open a bar, your dream can come true today. Because guess what? If you
That's
operate,
true.
so that's that. These are the things that we're seeing. But Taiwan, you said something that I thought was interesting about the tech companies. And one of the brightest spots in 2020 was the amount of lease space that these
Right.
companies took. They took 1,000,006 square feet. Amazon bought a building for close to $1 billion. They bought the Lord and Taylor building on
Yes.
Fifth Avenue. Granted, they closed right around the pandemic, so it was a deal that happened before. But still, Facebook, TikTok, Netflix, all of these took huge spaces in the city in the pandemic. So what does it tell me? It tells me that they believe that their employees want to be in the city, in an office,
Yeah.
in the long run. And
Plus, it's very opportunistic. The rates must have been great on those as well.
Well,
I'm sure that's a part of it, but it's really here. It's like you want to be in the office or not, you have to have a physical space.
Right.
yeah. Well, the city is the golden grail, right? So
Yes.
you're a college student. You went to school somewhere, Kentucky.
Yes.
You know, I went to school in West Virginia, and you dream about coming to the city and taking the A train, right, and going to Manhattan.
Nobody dreams
So-
about taking the A train, man.
well, not the A train, but I think that's the golden grail, and you have a lot of people that still are excited about that. I mean, I haven't been to the city, in a while. I've driven through, put my I put my son in the car seat and we drive through. We don't get out, but I think everybody still wants that feeling of you're out of college, or even as an adult, right? You love coming. It's something that going to an office does for you, and I think with Facebook and TikTok. Well, I think TikTok just want more people to dance around on their app.
You're right.
But
Just more space for the videos.
They want more space for their videos, right? But they're taking this aggressive stance because social media has been on the forefront. I mean, look at what we're doing right now. We're on Zoom. I think I read something where the value of Zoom before the pandemic was okay, but now it's
Forget about it. Forget about it.
right?
So it went up, it went even further, it went down a little bit.
Thanks a lot, guy. I appreciate that. But actually, I think that's a really good opportunity to bring Brian in, because I think Ty, you made a really good point, and it goes to some of the things that Shimon was saying, sorry, about the influx of young people coming back to the city. Brian, I know you're doing well up in Harlem, because I know you're going to do well anyway, but
he's doing very well.
Doing well also. Are you seeing people that are in the city, moving upwards, or are you seeing still people coming in and coming into Harlem? What's the market looking like for you?
Yeah, I see people with children maybe getting a second home or moving out to the suburbs or the boroughs. I see young people coming into the city. It's an opportunity for them. And the rental market is really in the toilet. I mean,
to put it lightly, right?
Yeah, be frank, huh?
Right.
People really want, they want the home office, they want outdoor space, but I think young people are with the help of their parents, are coming into the city.
Right.
I'm seeing
A lot of co-signers.
Yeah.
Yeah.
Co-purchasers, yeah.
And Brian, first of all, I want to commend you, like I said before, that you were the first to think about being the mobile broker. Now we're all like mobile and on Zoom. So congrats on coining the name. That's great.
Yeah, and that's why I'm successful in the city, because and during COVID, because I'm not just stuck in one market. I'm also in Brooklyn. I'm in the Bronx. I'm in Westchester. I'm also licensed.
So I have a question for you, Brian. I have a question, and also for the Ariel folks, Shimon and Victor as well. So like I mentioned, born and raised in Bed-Stuy, and from what I've noticed, there is a house that was, across the street from me on Putnam Avenue. I think it was at 1.3, 1.4 before the pandemic, and in the middle of the pandemic, it was 1.3, 1.4, and even now that the pandemic is still 1.3, 1.4. Why is that? Is it just the resiliency of just brownstones and Bed-Stuy? Why hasn't the prices, and from what I've seen, because I've watched this particular property, and it's a beautiful, gorgeous brownstone, right on the corner is a corner lot, but that price did not drop at all much.
It's also still in the market though, right?
It is still, that's true. It is still on the market. It is still on the market. but from what I've seen, I haven't seen much, and the wife and I, we were, fortunate enough that we moved, during the pandemic as well. So that was great. We, backyard is always a good thing to have.
Did the upgrade.
Yeah, but for the residential guys here and Brian and crew, from what I've seen in certain neighborhoods like Bed-Stuy, the prices haven't moved much. Why is that?
Right. Well, during the pandemic, I think Brooklyn outperformed Manhattan, Queens, Bronx. Those are sellers markets still. So I don't see that those markets were as affected as Manhattan was, and that's what people were moving to.
That's the thing, right? And I think Brooklyn also benefits from the brand of Brooklyn as well. I think I was having this conversation actually with a property manager friend who's a residential property manager, and she was saying, like, what really is Manhattan when you don't have the nightlife and the restaurants? Like, without the socializing and even Broadway, why are you in Manhattan, right? Why are you paying all this money for that small apartment if you don't have all those other things that make it great? And so I think Brooklyn didn't have that issue the same way that Manhattan does. I think that might be part of it, is that there's always going to be somebody looking for that.
And I have one more word for you. It's called motivation. Motivation. The seller might not be that motivated to sell, and supply demand is not there. So, but I wanted to speak about something that Vic and I are seeing in the market today, and I wanted to also ask Brian a question, if that's okay. We've seen, again, just moving forward with seeing the positive in the fundamentals. November, December, and January have been months where leasing activity has been much more robust compared to the year before. I mean, I think December was double than December 2019, and I think January followed suit. So we're really seeing a major shift where we saw vacancy. Now vacancy is starting to fill up and do well. Granted, it's in lower prices. So
and that's just what I was going to say. I think a lot of that is, hey, let's get this opportunity. Let's graduate up. Yeah.
Exactly it. And so the city really found its footing in a way. And that tells me again that people believe that in the next year or two, these are not going to be, the rents are going to be where they are plus. So right. So that's a great thing. I'm curious to know also about the for sale market, Brian. I don't know if you can talk to it a little bit, but even in Harlem or locations, doesn't necessarily, I don't necessarily mean in Manhattan, but the lower pricing levels, have they started to transact in a more robust way? Who you're seeing buying, who you're seeing active in the condo market in Upper Manhattan, or in general in the, let's call it 4 million and lower, or 3 million and lower? Is there any activity there today? Because we know the luxury market is a little slower, although it improves, but on the lower levels of things, are people buying today, like condos?
Yeah, I think definitely I'm seeing transactions, and I'm doing deals, both more, of course, more below $1 million, but I've had a couple who bought from me. They're from the Midwest, and their father bought it for them cash, and
wow,
it was over $1 million, and it's happened in Harlem. So it depends on what it is. I mean, it depends on. It's a tale of two cities. It's not just one.
Yeah.
That. So it depends on if it's something people want. People want to see from the kitchen to the living room. They want an open floor plan. If it's a product they want, and I see this is a great opportunity for developers, to deliver a product that people want to buy, in the future. So, yeah, it depends on what. It's not one answer to that, Shimon.
Thank you.
Shimon, within the same vein of optimism, right? I think you're right? I feel that we really did bottom out as a market in multiple aspects in the end of 2020. And I think you could attest to it. It feels like we're in the slow, steady grind upwards, right? Little by little, like, not saying that things are going to improve, tremendously overnight, but you saw that leasing activity and leasing data is moving positively, like you said. That's actually showing up in the data. And now actually contract activity for our investment sales market, right, has really picked up in the past 30 days. I don't think we've seen as many PSAs executed, as we've seen in the last 30 days for quite a while, right? So it seems like it's trending in the right direction. And I think, Derek, it was you that said, or Taiwan said it, that, there is a little bit of fear of missing out, right? At a point where, you want to buy at the right time, you want to lease at the right time. I've actually had contacts that work for these institutions telling me that they're coming back, they're looking at apartments now because they want to beat the spring, summer, renting season,
Exactly.
which is always like the most busy and active
Right.
season. So I think these are positive things. Again, I don't think it's going to be, overnight, all of a sudden we're back to where we were, but I do think we have this slow, steady improvement that's trending in that direction, and will continue.
Yeah, Vic, I wanna build on that. I think I'm in the office today, right? I'm here 3 times a week. Between my wife and Vic, they let me stay out, work from home twice a week. So that's good. But I'm in the office today, and it's, I think, the first time that out of going up and down in the elevator for, let's say, 4 or 5 times, most of the times I did go with someone else.
Mm.
The first time where I started seeing more people on the street. Now, the vaccine is here. The summer is coming in. And we've been through a summer of pandemic already. So people are much more comfortable, in my opinion, going out, sitting in a restaurant, kind of craving it. The other thing is, I think that for people with kids like myself, we're sending them to camp. We couldn't last year. So people are going to start moving a lot more during the summer. And I think the psyche is going to completely change.
Of
I
course.
think September, if you think about it, universities and colleges are going to probably open.
I think so. Yeah, normally. Yeah.
And if you have students coming in, all of these vacancies we were talking about are going to be filled up, not at the same level, not at the same price, but filled up in a way that we haven't seen for about 18 months. So all of these lead me to believe that a change is, like Vic said, gradually happening, and slowly but surely will snowball into something great and into 2022.
Yeah, I think that's great. I agree, because like it's interesting, right? Because there's a lot of negative people that want to say, oh, Manhattan's dead, the city's gone. It's like the idea that the city's never gonna go back makes no sense. And the fact that, as you said, there's reason to believe it'll come back much faster than what people thought at the same time. To have such positivity even before the turn of the year, I think is tremendous. It really speaks to the positive outlook that people have that want to be in the city. And I agree that people are going to come back. Like I hear people talking about, oh, can I move my license to Florida? I'm living with my parents now. But I think that person's coming back to the city eventually as well.
And you know what? To piggyback that, it's going to come back and it's going to be different. Deals are going to be done differently, right? And what I mean by that now is, since I'm in the property management realm, property managers are going to have to think about spacing, hand sanitizer, on every floor. What does that look like? So, it's going to be very interesting because building owners are going to have to start to think about having COVID protocols, because regardless of anything, even though when we do come back strong, like normal, masks aren't going anywhere.
Yeah.
Germex hand sanitizer is still going to be $50 a gallon or whatever. The wife and I, we just went to Costco the other day and picked up a gallon. I tell her every time you go, make sure you get like 2 or 3 just in case, right? So, now it's going to be the fact that property owners and property managers are going to have to start to think about these measures, because some tenants are going to ask, hey, what are your COVID protocols? What are you doing? I need a hand sanitizer, my station, maybe an extra bathroom. So when these deals are getting done and you're doing these build outs, that's going to be important, as well. And I'm pretty sure in the residential market, like, Brian could tell you, maybe think, what are tenants asking for in regards to COVID? So we're going to come back. We're going to come back stronger than ever. We're going to have high school football again in New York, thank God. Right. But it's going to be a different play as property managers and building owners start to kind of rethink the way that people interact with one another.
One of the things that Vic and I get asked a lot by mostly buyers and capital that's super interested in New York City is, where's the distress? And one of the things I tell people, and Vic will chime in a second, is, look, it's not going to be 2009 and 10 and 11. It's going to be completely different. And one of the reasons is because over the past decade, conventional lenders were very careful with placing debt, and there's a tremendous amount of equity gap. But there's going to be some distress in 3 buckets that we identified. One is in luxury condo market. Second is in COVID-related distress, which is mostly hotel and hospitality and some retail. And the third is in some multifamily situations where the lender wasn't necessarily a conventional lender. Vic, you want to add to that or get a little bit more granular with regards to the distress that we're seeing or about to see, hopefully, or some point this year?
Well, I don't know, hopefully, if
Yeah.
it's all right.
Needs to clean up. It needs to clean up, but yes, it's not hopefully.
I think the distressed market that you're seeing that's actionable right now is the distress that happened before the pandemic, right? You know, and a lot of times it's related to HSTPA or just big bets that didn't pan out, you know, in some cases because the business plans, you know, became obsolete in the middle of it or extinct in the middle of it. I think going forward, you're right, Shimon, that it's going to take time to unwind and really figure out the right solution in a lot of these cases because, you know, I think there's going to be a ton of contested foreclosures, right? I mean, there's a million reasons why a foreclosure can be contested. The court system is going to be jammed.
Yeah.
It's already the most inefficient court system probably in the country.
Legitimately is. It legitimately is.
And then when you couple that with, you know, how backlogged they're going to be, it's going to be just extremely brutal to get through these. So I think, you know, it would behoove a lot of the lenders in this case to take a more pragmatic approach where, hey, maybe it's time to work something out now. Instead of going down this road, let's figure if we could work it out. Doesn't need to be with the same borrower, by the way. In a lot of cases, these borrowers they're so fatigued, they just want out without, you know, they want out of their liability. They know their equity is toast and they just want to avoid this long, lengthy legal process. So I think in a lot of cases, if the lenders, you know, approach these situations, categorize the loans the right way, because they do fall in different buckets, right? And have a pragmatic approach for each. Like for instance, right? A lot of these loans, you know, they were done with much more equity than before, Shimon, right? You're absolutely right. But still, if you look at, you know, the shifts in value, their leverage is getting up there, right? So when you talk about a sale, you know, there's not much that can go around there. So, but if they could find a new sponsor to come in that has that strength, pay them now, de-risk them today, right? So they actually get money today and modify their terms to give that new sponsor some runway to stabilize a messy situation. They'll end up way better than going down a lengthy, messy litigation road where it's going to take them 3 years. And guess what? They're going to end up worse, right? They're going to end up getting, you know, 70 cents on the dollar and instead of 90 to 100% of their original investment. So it's going to be really interesting. And, you know, we've seen it, Shimon, right? We've seen some lenders open to talk and say, hey, you know, we get it. And we've seen some other lenders put their head in the sand and just say, Pasha, we don't care, right? We want the asset. Good luck to you, right? So really interested.
So Victor, sorry.
Whoa, whoop, wrong button. You muted, Ty.
It's on mute.
Mute. You're mute.
Sorry. Can you hear me now?
Yes.
Yeah.
Sorry. So Victor, quick question for you. So a lot of these CMBS loans, do you see a lot of these owners walking away and letting it fall into receivership? Because I've read an article, you know, and it's very interesting. I had a buddy of mine who had a company, and now he's managing properties that fall into receivership. So do you see, you know, especially these CMBS loans, and I think The Real Deal, they did an article a couple months back about the whole process of these CMBS loans. Do you think
brutal? That's brutal.
Yeah, it is. Do you see owners just giving the keys back for these CMBS loan properties?
Yeah, but you know what? Before that, you touched on it, Taiwan. A lot of times they'll wait until a receiver is appointed, and before that receiver is appointed, they'll start sucking the cash out of it as much as they can because it's going down that road anyway, right? And it takes time to appoint a receiver today, right? Like, yes, we're seeing that where people are essentially fighting tooth and nail before taking that step of not necessarily giving the keys back, but basically just stopping to pay, right? And saying, you know, getting the cash flow from the property, putting it in their pocket, and then just at some point walking away. And maybe they'll hand over the keys for some nominal amount. Maybe they'll go through the foreclosure process anyway. But I do think we're kind of at that point approaching now where they're going to be left with no better alternative, right? They're not recouping. If they sell in a lot of these instances, they're getting zero anyway, right? They're coming out of pocket, matter of fact, to sell. So the alternative for a lot of them is going to be, hey, you know what? At some point, we're just going to start sucking the cash out of the property, stop paying the debt. And, that's why I'm saying that I think, this really needs to be thought through from both, the lender's approach in these instances.
Yeah, so if I'm a lender, right, then moving forward, so maybe something out of this will change. So I know a lot of lenders, they'll give these non-recourse loans. So after this, if I'm a lender, do I still give out these non-recourse loans? Because if that happens, like a situation, you're kind of just stuck.
Taiwan, it depends. It depends because if you have a loan on a multifamily building and with a stable cash flow, and you're giving a low loan to value with a debt coverage that's high enough, you absolutely don't need any other guarantees. You need a good guy guarantee. So if something happens, they hand over the keys.
Yeah.
On the flip side, if you have an office building that needs to be converted, and eventually the construction loan you're taking needs to be converted to permanent construction loan, permanent loan, then yes, you need guarantees, and you possibly need some carve outs and some personal guarantees and so on. So I don't think the world changes that much in terms of the lending environment. And I think that just the CMBS world is interesting because one of the things that the non-CMBS lenders, that the local lenders did, is worked with their borrowers throughout the pandemic, which was crucial. Because if I'm not collecting from my retail tenant, from my fair market tenant, I can't pay. So they gave relief for months. They didn't give up a principal, but they gave relief for a while for some of their borrowers.
Yeah, and I think and relief is big. So what a lot of the REITs did. I can't speak for many, but what was happening is if a tenant says, hey, you know what, I can't pay for the next 3-4 months, property managers like myself and others, we were tasked at doing these workouts. So we would say, all right, we'll take these 3 months, we'll get it given maybe an abatement for 1 or 2, and then we'll either tack it on to, the back end of your lease.
That's
or
right.
we'll work out something. So at least you can go to your lender, especially if you're required, at least you can go to your lender and say, hey, I have this document signed by a tenant saying that they couldn't pay now, but they're at least going to pay later. And some tenants, some workouts even happened where it was done in the summer of 2020, and they're just starting now in January of 2021, where they would pay their base rent, CAM charges, additional rent, plus that workout rent, $300, $400, $500 a month, or whatever it is. So,
yeah, and I think if we're talking about the debt side, let's talk about the equity, because one of the things we're seeing is that new capital is here. Again, another positive sign of people. Not all of them are transacting right now, but high net worth individuals, family offices, people who never invested in the city nationwide, coming in and looking in, some new platforms that are looking to invest from overseas or develop funds here to buy properties. And if you talk specifically about affordable housing, also mission-driven capital. And all of that makes me really believe that we're at the very tail end of this, not only pandemic, but this downturn. And as the pandemic improves, so to speak, as lifestyle improves, as we can go out more, as we can eventually take off our masks, I think that's going to contribute tremendously to the positive life of New York City.
And I think what better way to end this segment than that? Honestly, I think this has been a great conversation, and I honestly could go a little bit longer because I have some questions I still want to ask, but I'm going to be respectful of you guys' time. It is exactly 6:59, as I can see on my clock. And I thought that was such a great statement that you made there. I think that would be a great way to end it. And so I really appreciate you, Shimon and Victor, coming on and sharing with us. Thanks to the congressman for his statement. That was very kind of him. And really, really great conversation. I loved your projections, and I'm looking forward to hearing more from Ariel PA moving forward. All of you that are joining us today, definitely check out their website, view the reports they're having. And Shimon, why don't you go ahead and talk a little bit about your podcast before we go as well?
Yeah, thank you. First of all, thank you for having us. We have a podcast called Coffee and Cap Rates. Vic, Mike,
I love that title.
Sean and
Yeah,
I.
that is good.
Yeah, it's not me. Someone else put it together. But Vic, Mike, Sean, and I did the latest podcast talking about the different things in the market. Please visit us on our website, rielpa.com, and enjoy this. We do it every few weeks, and enjoy this. And thank you so much, Derek. Thank you so much, Taiwan. Thank you, Brian. Vic and I are grateful for you guys having us here, and we're grateful for our relationship. So thank you for that.
Thank you both. It was a great conversation. Like Derek said, I could talk to you guys for about another hour and a half, but
Give us a call.
Yeah, there you go. Right, exactly. We're going to definitely be tuning in on the podcast, and I will say, we're working on next month's segment for $1 Million Thing. So keep your eyes on your inboxes for more information on that as well. Brian, you want to say goodbye to everybody, and thank you again for your time as well.
Yeah, thanks everyone for joining. A very informative session. I learned a lot about a lot of commercial talk here.
Yeah.
So it all in.
Hint, more residential talk next time. I know. All right. Thank you, everybody. Really appreciate everyone's time. Thank you for joining us, everyone. Have a great evening.
thank you all. All right.